What's up guys, it's Cody. Today we're talking about hard money lenders, how you can find one and get the best terms possible so that you can go out and fund your next real estate investment deal. Now, the purpose of this video is to give you an alternative way to finance your next property or even get money for a down payment or for repairs or anything that you need, but you need to be careful because hard money lenders, as we're going to talk about, can be very expensive and you can put yourself in a pickle really easily if you don't have the right exit plan in place. So the first thing that I want to talk about is what is a hard money lender, how do they work, and what can you expect from them. So a hard money lender is somebody who is loaning private money or money that is pooled from different investors, and they're going to loan that money to you based on a specific deal that you have. And what they're going to do is they're going to use your property as collateral. So this is very common when doing fix and flips, that you will get hard money on the house to be able to purchase it with cash. You're going to fix it up and then sell the property and then pay off the hard money loan. Now, there's a couple of benefits to doing it this way. You have the ability to purchase the home with cash. It's very quick. You can get money in as little as 1 to 2 days, and you're able to put together deals that may not happen if you had to go out and get traditional financing. The other nice thing about hard money lenders is they're more concerned about the actual deal rather than what your credit profile looks like and how much money you make. They want to see that you've got a track record and that they're going to get paid back after you sell or refinance your property. The other thing to note here is that even though they're going to put a lien on property of yours, it doesn't necessarily need to be the property that you're going to use the money for. For instance, I had a deal that I did about a year ago where I borrowed money and put a lien on one of my rental properties in order to get money for a down payment to purchase a new one. Now, I only did this because I knew that I could use that hard money as a down payment on a new property that I was then going to fix up, place a tenant, finish some title work that needed to be done on the property, and then refinance it for more than I had borrowed in the first place. If you haven't seen this video on my channel yet, I'm going to link to it right here. Go and check it out. There's some really good information in there about how I bought the property and then pulled out 100% of my money and paid off the hard money lender to be able to do this. This is just one example of how you can use hard money. And the really cool thing about hard money is that it's very flexible. Like I said, you can get this money in as little as 1 to 2 days, sometimes quicker. You can already have it lined up so that you can go and purchase properties as soon as a deal comes up. So now that you have a good idea about what a hard money lender is, let's talk a little bit about how to actually go out and find a hard money lender and establish a relationship with them. The first place I think you should start is by connecting with other investors in your market. You can do this through online forums like BiggerPockets or Facebook, or you can do this by connecting with them through local real estate investors associations. I highly recommend going to these meetings because this is where you're going to meet other investors and you can start building those relationships and finding out who has the deals. In my market, a lot of times the big players that are doing a lot of deals, whether those are fix and flips, wholesales, rentals, lending hard money, they're going to these meetings and they're networking with each other to build those relationships and find deals that they can do that others may not be taking on. Now, one thing that I do want to warn you is that in the very beginning, if you're just getting started with hard money, you will either need to have a property that you can put a lien against, or there needs to be enough room in the deal that the hard money lender feels comfortable with you. Every hard money lender's criteria is a little bit different. They're all going to be looking for different things, but generally in the start, you can expect that they're going to give you about 80 to 90% of the purchase price, but you're going to have to cover the rest of the purchase price. On top of that, you're going to have your repairs and some potential closing costs and holding costs as well. And those are generally items that you're going to have to cover out of pocket that the hard money lender will not lend on. The reason why they do this is because they want to make sure that they have enough margin in the deal that if you default and leave them with a house that's completely torn apart, they can go in, do some fix up, and then turn around and sell it and still get their money out of it. Similar to how a bank would work. Once you've got a track record built up or you've got enough assets and income, hard money lenders will typically get a little bit more lenient with the criteria that they have for you. A lot of times they'll just take a quick glance at the deal and say, yes, I will lend on this. In fact, I know some hard money lenders who will lend up to 100% of the purchase price or even the purchase price plus some of the repair money to be able to get the deal done. Now, these types of deals are typically reserved for experienced investors who have a good track record and they've got a deep relationship and have done a lot of business together between the hard money lender and the investor. They're typically looking at the strength of the deal and how much margin there is in the deal. So if you've got a home that you can buy for $200,000, but it's going to be worth $300,000 after it's fixed up, they want to know that after they lend you the money, you've got enough room to put in some money for repairs, as well as pay any closing costs or selling fees like commissions or holding costs such as taxes and insurance, and you're going to be able to pay off the hard money after selling the property, and of course you as the investor will still get paid on the deal in addition to paying all of those other fees. So let's talk a little bit about the rates and terms that you can expect with hard money. But really quick, if you would guys, if you're enjoying this video, please subscribe to the channel, click the bell if you'd like to get notified when I drop new videos like this. We're going to be covering a large range of topics here and I'd love for you to be a part of it. So looking at the rates and terms that you can expect with hard money, again, this is totally flexible. It depends on the lender that you go with. In my market, you're typically going to see anywhere between 10 and 14% on the interest rate and 1 to 2% in origination fees. As you know, this can get very, very expensive, especially when you're borrowing $200,000, $300,000, $400,000. It adds up really quick. It's for that exact reason why I don't recommend using hard money unless you have a solid exit plan in place. Just looking at the origination fee and what that would be if you were to borrow $300,000, you would be looking at $3,000 to $6,000 in fees just to get the money. That's not even counting each month that you have that money until you pay it off. If you're paying 12%, that's going to be another 1% each month that you're paying. This adds up to $3,000. This is why it's so important for investors to flip deals as quickly as possible. And even if they can do it in 1 to 2 months, they're still looking at about $10,000 in interest just to borrow that hard money for that deal. So again, I stress that you need to have a deal that has enough margin in it that you can still afford to pay off the hard money if you're borrowing it, and then still sell the profit, pay back your repairs, pay off the loan, and of course, still make a profit. The last thing that I want to mention here is that hard money lenders will typically loan you the money for anywhere from 3 to 6 months. Now, let's say this is a bigger project and you have to tear down the home almost entirely, then they may lend you up to 9 months, 12 months if needed, but they'll typically keep it on a shorter term of about 6 months and then reassess once that time comes up. Most experienced hard money lenders and investors know that a deal should be able to be flipped in about 2 to 4 months on average, depending on the timing of contractors and how on top of it the actual investor is. One other thing that I want to mention about hard money lenders is that it's a good idea to have multiple lenders lined up so that if one is too slow to analyze a deal for you or they're unwilling to lend on it, you've got a backup plan. The worst position to be in is to have a great deal but not be able to find the money for it. Some lenders might not even like your deal. Maybe there's not enough margin in the deal, maybe they don't like the location, or the scope of work is too much. So you want to make sure that you've got multiple lenders lined up and ready to go to invest in your deal. When it comes to exit plans, typically you're looking at either selling the property or refinancing out of it. It's always a good idea to have multiple exit plans in case one does not work out. Let's say the market turns and you're unable to sell the home. Then you want to be able to go out and get a mortgage on the home that's going to be much cheaper than the hard money and at least be able to rent the property. The last thing that I want to mention is that a hard money lender can be just about anybody. It could be somebody in your neighborhood, it could be somebody you grew up with, or even just another investor in your market. It's important to keep this in mind because you want to make sure that you're asking around trying to see who has money and who's willing to lend that money in case you have something that comes up. I know a lot of investors who borrow from lawyers and doctors who have large sums of money that they want to invest but just don't know where to put it. They'll lend it to these investors. The investors will take this money, do a deal with it, and then pay back the doctor or lawyer, providing them with a really good return. Typically, you can get more favorable rates on deals like this because you're borrowing from a private person instead of somebody that's working as an institution or in a more professional sense. So that just about wraps up the video, guys. If you have any questions, I'd love to hear about it in the comments below. Again, give me a thumbs up here on the video if you enjoyed it, and subscribe to the channel and click the bell if you want to get notified. each time I drop a new video like this. I really appreciate you watching till the end. Until next time.